Hey everyone, and welcome back. Today, we're going to dive into a simple, but honestly, an incredibly powerful price action pattern. It's clean, it's easy to spot, and it's designed to help you catch some of the biggest moves in the market. So yeah, let's get into the Inside Bar Breakout. So have you ever felt just overwhelmed? You're switching between all these complex strategies, all these indicators, and nothing seems to click? Trust me, you are not alone. It feels like every trader is searching for something that's both simple and effective. And the good news is the solution might be hiding in plain sight, right there on your charts. And that's where the inside bar comes in. See, this pattern, it's all about spotting those quiet moments. A pause, a moment of indecision in the market that so often comes right before a huge, powerful move. It's like the market is taking a big, deep breath right before it takes off in a sprint. Okay, so if we want to trade this thing like a pro, we've got to know exactly what we're looking for, right? So let's break it down. What is an inside bar? At its core, it's super simple. It's just a two-bar pattern. You've got this one bigger candle. We call that the mother bar. And then the candle right after it, the inside bar, is completely swallowed up by the first one. I mean, literally, its high and its low are both inside the high and low of that mother bar. And this is the key thing to remember. The mother bar, it draws the lines. It sets the boundaries for the immediate price action. The inside bar has to play within those lines. It has to make a lower high and a higher low. And when you see that visual containment, well, that's the market consolidating. It's tightening up. But what's really cool is the psychology behind all this. This quote here from Akil Stokes, man, it just nails it. He talks about this contraction and volatility. It's like you're compressing a spring, tighter and tighter and tighter. And what happens when you let go of a compressed spring? Boom! A massive, powerful expansion. And that expansion, my friends, is the breakout we are hunting for.
Okay, so we know what it is, we know the why behind it, but how do you actually make money with it? How do you trade it? Let's get practical. I'm going to give you a simple 4-step playbook you can use. It really just comes down to these 4 steps. Step 1, you got to spot the pattern. Find that candle tucked inside the previous one. Step 2, plan your entry. Now, don't just jump in, you place an order just outside the mother bar's range. That way, you only get in after the breakout actually happens. Step 3, and you cannot skip this, set your stop loss right away. Put it on the opposite side of the mother bar to define your risk. And step 4, know where you're going. Have a target. A good rule of thumb is to aim for at least double what you're risking. And this table here just lays it all out so clearly. So if you're going long, if you're buying, your entry gets triggered when the price pops above the mother bar's high, your stop loss tucked right below the low. And for a short trade, you just flip it. You sell when the price breaks below the mother bar's low and your stop goes right above its high. It's so clean, right? Just perfectly symmetrical, makes total sense. Okay, but let's be real. No trading strategy works every single time. So we need to talk about the most important part of any trading plan, defense. Think of it like building a shield. We got to manage our risk and learn how to dodge those really, really frustrating false breakouts. I mean, it's the question we've all asked, right? You see the perfect setup, you put on the trade, the price breaks out just a little bit, and then bam, it reverses hard and stops you out. That right there is the classic fake out. It's designed to shake out traders before the real move happens. But the good news is there are ways to spot these traps and filter for the really good setups. Think of this slide as your playbook for stacking the odds in your favor. First off, don't fight the river. Trade with the dominant trend. It's just easier. Next, look for volume. If you see a big spike in volume when it breaks out, that's like a huge confirmation that the big money is behind the move. Also, try to stick to higher time frames like the daily or the 4-hour to filter out a lot of that market noise. And please, stay away from trading right before a big news announcement. That's just asking for trouble. And finally, remember this. Context is everything. An inside bar that forms at a huge support or resistance level, that's way, way more powerful than one that's just floating around in the middle of nowhere. You know, this failure pattern is so common, it actually has a name. They call it the fakie. It's an inside bar that fakes a breakout. The market pokes its head out one way, sucks in all the early traders, and then just slams back in the other direction. Now, spotting this is super important because, and this is a bit more advanced, a failed breakout can sometimes be an incredible trading signal itself, just in the opposite direction. Okay, that's enough theory for one day. The best way to really get this stuff is to see it in action. So let's pull up some examples and see how this actually plays out in the real world. Check this out. This is a perfect example on the S&P 500 daily chart. And remember what I said about context? It's everything. Look at this. We're in a monster uptrend. Then the market just takes a breather, and it forms this really nice, tight inside bar. This isn't screaming reversal. It's whispering consolidation. It's getting ready for the next leg up. So we just follow our playbook. We place a buy-stop order right above the mother bar's high at 51.75. Our stop loss? Right below the mother bar's low at 51.25. See how clean that is? Our risk is perfectly defined by that one candle. And now, we just sit back and let the market do its thing. And what was the result? The market just exploded higher. It ended up hitting a target that gave us almost a 3-to-1 return on our risk. I mean, that's the whole game right there, catching that massive expansion after that little squeeze. Just a beautiful, clean setup and an amazing result. Okay, so that was a buy. Let's look at a short trade now, just to show you how this works both ways. This is the euro-dollar on the daily chart. You can see the market had just broken below a really important support level. That's a big bearish signal. And what happens next? An inside bar forms. That little pause right after a major breakdown, that is a classic sign that the sellers are just catching their breath before the next big push down. So the setup is exactly the same, just flipped upside down. You put a sell stop just below the mother bar's low, and your stop loss goes right above its high. And sure enough, the price breaks down, keeps falling, and eventually hits a target that gives us another sweet 3-to-1 reward to risk ratio. See? It's the same simple, repeatable process. All right, so we've covered a ton of ground here. We've defined the pattern, built a whole trading plan around it, and we've even looked at some real-life examples. So let's boil all this down to the key things you absolutely need to remember. The really big idea here is that there are basically two main ways to use this pattern. The first way is as a trend continuation. This is where you're trading with the current trend. This is usually the higher probability way to go, especially if you're just starting out. The second way is to look for reversals off of major levels. Now, these are a little trickier, they're more advanced, but man, when they work, they can lead to some absolutely explosive moves. I want to leave you with this quote because I think it's just perfect. It really sums up what separates the pros from everyone else. Look, this pattern is simple, so you're going to start seeing it everywhere on your charts. But the secret is not to trade every single one you see. It's all about patience. It's about discipline. It's about waiting for those absolute A-plus textbook setups. Because when you get those big reward to risk ratios on your winners, you can take a few losses and still come out way ahead in the long run. That's the whole game.
And that kind of brings me to my final question for you. So now that you know the two main ways to play this, which one feels more like you? Are you a trend follower? Do you like those high probability continuation trades? Or are you more of a reversal trader, hunting for those big turning points at key levels? It's definitely something to think about as you start spotting this awesome pattern on your own charts.